Powell's higher for longer mantra isn't exactly what consumers want to hear following a fourth straight month of hotter inflation readings. For more on what the Fed's rate decision means for you and your money, we've got Andrew Slimmon, who is the Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Great to see you here this morning. Okay, just want to get your reaction to what we heard from Fed Chair Jay Powell yesterday and what this means for individuals out there right now who were expecting, like many of us, multiple rate cuts this year. And it seems like we might only get maybe one, maybe none, as some of the chorus of the no cuts this year continues to grow right now, Andrew.
Sure. Good morning. So, look, I think there's good news and bad news, and I'll start with the bad news. I think the bad news is a lack of rate cuts will hurt investments that are dependent on lower interest rates. It will hurt consumers that have higher levels of debt because we won't see debt relief. I think, many ways, this is one of the reasons why small caps have underperformed year to date, because they are more dependent on lower rates. So that's bad news. Now, the good news is what the Fed is really telling you is that they are comfortable that the economy is strong enough that they can be patient on inflation. And the reason why that's important is because if I think about where the market is today and where it could end of the year, the market is going to be priced off of next year's earnings. And if the Fed is saying today, we're good, the economy is strong enough, that leads me to believe that the end of the year, we could be starting with an S&P earnings estimate somewhere around $280. And that makes the stock market relatively attractive today as I think about where it could end the year.
And Andrew, for a lot of people out there who have a very distinct memory of how long we were in the transitory phase and how the Fed was classifying it that way, what's the risk that we remain in the higher for longer, for too long type of phase?
Well, that's the risk. The risk is that the Fed hangs in there too long and then the economy weakens. And one of the ways, I think a little trick or not, a way to watch that is really the 2-year yield. Because right now the yield curve is inverted, and that means the 2-year is higher than the 10-year. But if the economy were to start to show signs of weakening, you would see the 2-year yield start to drop. And that hasn't happened yet. And I understand there's inflationary pressures, but that hasn't happened. And typically stocks do fine when the yield curve is inverted, but they begin to weaken when you get that uninversion, because usually that's the 2-year dropping. So to me, it continues to point to the economy is strong enough to handle it, but there's no question, and you're absolutely right, that the risk is that they can overstay their welcome. Look, coming out of first quarter earnings, I'm extremely happy with what we've heard. Not every company was great, but largely overall, I think the quarter was strong and companies were relatively optimistic. So I think there's a good setup for the stock market to recover after certainly a weak April.
Is there a portfolio repositioning that investors out there should be considering right now as it pertains to how they're trying to navigate the Fed's time horizon for when that first rate cut could be, and even if it is pushed out to next year, for those longer term investors anyway, is this going to initiate some type of major pivot in their strategy?
Sure. Well, I think the thing that I find so amazing is the amount of money that's poured into the money market funds. The $6 trillion is sitting in money markets. That's up over $1 trillion over the last 12 months. And on the one hand, you'd say, well, Andrew, that's because, money markets are yielding 5%. And boy, oh boy, 2-3 years ago, it was 0.5%. So certainly it looks more attractive today. But the problem with that that comment is people are forgetting that inflation is significantly higher today, and that's what the Fed, the reading. It's not what we all live with. So the tragedy here is that on a nominal basis, 5% looks attractive, but after inflation, money markets are not really more attractive today than they've been in the past. So, in other words, investors aren't making great returns in the money market. So, I think repositioning, it's that recognition that it's not creating a great return after inflation will force investors into other assets, not all, some equity, but not all stocks. It will be into bonds and other types of maybe gold, other assets that aren't really, as I said, the money market inflation kills money market returns over time. You get better returns in assets that can withstand some inflation.